Preparing for FP&A Analyst at ScottishPower interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a business like ScottishPower? FP&A turns operational information into decisions. At ScottishPower, that could mean connecting customer demand, network investment, generation output, commodity prices, and operating costs to budgets and forecasts. I would provide reliable analysis, explain variances, challenge assumptions, and highlight risks and opportunities for management. The role is not simply reporting historical numbers. It is helping leaders allocate capital, manage performance, and understand the financial consequences of strategic and operational choices. While answering, focus on planning, forecasting, performance analysis, decision support, business partnering, cash discipline, and how FP&A connects operational activity with financial outcomes in a capital-intensive energy business. Question 2. Why do you want to work for ScottishPower? I am attracted to ScottishPower because it operates in a sector undergoing major change, with significant investment in networks, renewables, and customer solutions. That creates a challenging FP&A environment where assumptions about demand, pricing, capital expenditure, regulation, and project delivery matter. I would value the opportunity to apply strong analytical and communication skills in a business with a clear energy transition agenda, while learning how finance supports resilient infrastructure and long-term commercial decisions. Make sure to cover ScottishPower's energy sector relevance, renewable transition, infrastructure investment, regulated and competitive activities, analytical interest, and your motivation to contribute through accurate, commercially useful financial planning. Question 3. Walk me through how you would build an annual budget. I would begin with strategic targets and key planning assumptions, then translate them into operational drivers. For ScottishPower, I might model customer volumes, energy prices, generation output, project milestones, headcount, maintenance, and capital expenditure. I would gather submissions, challenge unusual movements, consolidate business unit plans, and reconcile the income statement, balance sheet, and cash flow. Finally, I would document assumptions, secure stakeholder approval, and establish monthly variance tracking against the approved budget. In your answer, talk about strategic guidance, operational drivers, bottom-up submissions, headcount, opex, capex, revenue, cash flow, challenge sessions, consolidation, approvals, and documented assumptions with clear ownership. Question 4. How do you prepare a rolling forecast? A rolling forecast updates the expected full-year or forward period outcome using the latest information. I would lock actual results, reassess the remaining months using operational drivers, and discuss changes with budget owners. For example, lower wind generation, delayed project spend, or changing commodity prices could alter the outlook. I would compare the latest forecast with budget and prior forecast, explain movements, quantify risks, and track accuracy so the process continuously improves. Be sure to mention using actual results to date, refreshing remaining period assumptions, driver-based modeling, scenario analysis, stakeholder input, forecast accuracy, and avoiding automatic reliance on the original budget. Question 5. What is the difference between a budget, forecast, and actual result? The budget is the approved financial plan, usually prepared before the year begins. The forecast is management's current expectation of what will happen, incorporating new information during the year. Actuals are the results recorded through the accounting process. Comparing actuals with budget measures performance against plan, while comparing actuals with forecast tests whether expectations remain realistic. Together, these views distinguish accountability from prediction and help management take timely corrective action. Focus on the budget as an approved plan, forecast as the latest expectation, actuals as recorded performance, and how comparing all three supports accountability, learning, and forward-looking management action. Question 6. How would you investigate an unfavorable variance in operating expenses? I would first confirm the variance is genuine by checking the ledger, cost center, period, and coding. Then I would split it into price, volume, timing, mix, and one-off effects. I would speak with the responsible manager to understand the operational cause, such as contractor rates, maintenance activity, or an accrual reversal. Finally, I would assess whether the issue affects the full-year forecast, document the explanation, and agree corrective action or escalation. Make sure to cover validating data, decomposing price, volume, timing, and mix effects, consulting owners, distinguishing recurring from one-off items, assessing forecast impact, and recommending practical actions. Question 7. What financial drivers are particularly important in an energy company? Important drivers include customer demand, energy and commodity prices, generation volumes, weather, network usage, customer numbers, inflation, interest rates, and regulatory allowances. Project delivery also matters because delays can shift capital expenditure, depreciation, and expected returns. I would separate external drivers from controllable ones, quantify their financial effects, and use sensitivities rather than relying on a single point estimate. That makes forecasts more transparent and helps management focus on decisions within its control. In your answer, talk about demand, wholesale prices, generation volumes, weather, customer numbers, network investment, regulation, interest rates, inflation, project delivery, and the distinction between controllable and external drivers. Question 8. How would you explain a financial result to a non-finance stakeholder? I would start with the conclusion, not the spreadsheet. For example, I might say costs are £2 million above plan primarily because maintenance activity increased and supplier rates rose. I would separate those causes, explain whether they are temporary or recurring, and describe the impact on the full-year outlook. I would avoid accounting jargon, use a simple chart where helpful, invite questions, and finish with the decision or action required from the stakeholder. Be sure to mention leading with the business message, using plain language, linking numbers to operational causes, avoiding jargon, confirming understanding, and tailoring detail to the stakeholder's decision needs. Question 9. Describe a financial model you have built or improved. I built a driver-based cost forecast that replaced a manual spreadsheet with repeated monthly calculations. I separated assumptions, historical actuals, calculations, outputs, and checks, then linked costs to headcount, activity volumes, and supplier rates. I added scenario switches and variance reconciliation so users could understand movements quickly. After validating the model against prior periods, I documented it and trained colleagues. The result was a faster close-to-forecast process with clearer ownership and fewer formula errors. Focus on the business purpose, model structure, inputs and outputs, controls, scenario capability, stakeholder use, validation, and measurable improvement in speed, accuracy, transparency, or decision quality. Question 10. What makes a good FP&A model? A good FP&A model is accurate, transparent, flexible, and easy for another person to understand. I separate inputs, calculations, outputs, and checks, use consistent formulas, and avoid hard coding where assumptions should drive results. The model should show clear links between operational activity and financial outcomes, support scenarios, and reconcile to accounting data. I also include balance checks, version control, documentation, and an appropriate level of detail so complexity does not obscure the decision. While answering, focus on logical structure, transparent assumptions, driver-based calculations, controlled inputs, auditability, flexibility, error checks, appropriate granularity, version control, and outputs that support decisions rather than merely display numbers. Question 11. How do you ensure data quality in management reporting? I use a combination of reconciliation, validation, and review. I would agree the reporting population to the general ledger, check period cutoff and mappings, investigate missing or duplicate records, and compare results with prior periods and operational metrics. I prefer automated checks for totals, negative values, and unexpected movements, supported by documented review sign-offs. If an error recurs, I would address the root cause in the source or process rather than repeatedly correcting the report manually. Make sure to cover source system reconciliation, completeness, duplicate checks, period and mapping validation, reasonableness analysis, automated controls, review sign-offs, and a clear process for correcting recurring data issues. Question 12. How would you approach monthly management reporting? I would follow a clear timetable, confirm close status, extract validated actuals, reconcile key totals, and compare performance with budget, forecast, and prior year. I would investigate material movements with business owners, prepare concise commentary, update key operational metrics, and identify risks or opportunities affecting the forecast. Before distribution, I would complete reasonableness checks and obtain appropriate review. The report should arrive on time and tell management what happened, why it happened, and what should happen next. In your answer, talk about close timetable, data gathering, actual versus budget analysis, forecast updates, narrative commentary, KPI reporting, stakeholder review, quality controls, and timely escalation of material issues. Question 13. What KPIs would you monitor for ScottishPower? I would tailor KPIs to each business area rather than use one generic dashboard. Financial measures could include revenue, margin, opex, capex, cash flow, and forecast variance. Operational measures might include customer numbers, demand, generation availability, renewable output, project milestones, network reliability, and service performance. I would ensure each KPI has a clear definition, owner, target, and action threshold. The strongest dashboard combines leading operational indicators with lagging financial outcomes. Focus on selecting KPIs by business area, including revenue, margin, opex, capex, cash flow, customer metrics, reliability, generation availability, project progress, safety, and regulatory or operational performance. Question 14. How would you forecast capital expenditure on an infrastructure or renewable project? I would start with the approved scope, project schedule, contracts, committed purchase orders, and latest cost to complete estimate. I would map expected spend to milestones, include contingency and inflation assumptions, and challenge slippage or scope changes with project managers. I would also consider commissioning dates because they affect cash flow, depreciation, and operating benefits. The forecast should distinguish committed from uncommitted spend and show downside scenarios for delays, cost overruns, or supply chain disruption. Be sure to mention approved scope, project schedule, procurement commitments, cost to complete, contingency, milestone payments, inflation, financing, commissioning timing, and links to depreciation, cash flow, and returns. Question 15. How do you distinguish capex from opex? Capex generally creates or enhances a long-term asset and is capitalized when the accounting criteria are met. Opex relates to day-to-day operation, maintenance, or costs that do not create a separately identifiable future benefit. A routine repair would usually be expense, while an upgrade extending useful life may be capitalized, subject to policy and evidence. I would not decide from budget labels alone. I would review the substance, documentation, materiality, and accounting guidance, because classification affects profit timing, assets, and depreciation. In your answer, discuss capitalization criteria, future economic benefits, repairs versus enhancement, materiality and policy, approval evidence, judgment, accounting consultation, and the downstream effects on profit, assets, depreciation, and cash flow. Question 16. How would you assess a request for additional project funding? I would compare the request with the original business case and identify why funding increased, scope change, inflation, delay, or execution failure. I would validate the remaining scope and cost to complete, reassess benefits, cash flows, returns, and key risks, then test alternatives such as phasing or redesign. I would distinguish a timing issue from a deteriorating investment case and present a clear recommendation, including sensitivities and the governance approvals required before committing further capital. Make sure to cover original approval, root cause, remaining scope, cost to complete, benefits, return metrics, alternatives, risks, sensitivities, governance, and whether the request reflects temporary timing or permanent economics. Question 17. What is scenario analysis, and how would you use it in FP&A? Scenario analysis tests how outcomes change when important assumptions move together. I would establish a base case, then create plausible upside and downside cases around factors such as demand, energy prices, generation, inflation, project timing, or interest rates. I would quantify effects on profit, cash flow, capital expenditure, and funding needs, clearly documenting assumptions. The purpose is not to predict perfectly, it is to prepare management for decisions, triggers, and mitigations under different conditions. While answering, focus on changing key assumptions systematically, defining base, upside, and downside cases, quantifying income statement and cash effects, assigning probabilities where appropriate, and linking scenarios to management actions. Question 18. How would you analyze the impact of changing energy prices? I would first identify which activities are exposed and over what periods, separating contracted, hedged, and unhedged volumes. Then I would apply price sensitivities to relevant volumes and assess effects on revenue, commodity costs, margin, cash flow, and customer pricing. I would consider timing, basis differences, and operational responses rather than assuming every unit moves equally. I would present a range, explain the main assumptions, and coordinate with commercial and treasury teams before finalizing the forecast impact. In your answer, discuss exposure identification, volume assumptions, hedging or contractual arrangements, timing, sensitivity calculations, gross margin, cash flow, customer impacts, and communicating uncertainty without overstating precision. Question 19. How do you think about cash flow in an FP&A role? Profit does not equal cash, so I would forecast operating cash flow alongside earnings. I would consider working capital movements, supplier and customer timing, tax, capital expenditure, project milestone payments, financing, and non-cash items such as depreciation. In ScottishPower's investment-heavy environment, timing can materially affect liquidity even when long-term returns remain attractive. I would reconcile cash forecasts to accounting outputs, identify downside funding needs early, and highlight actions that improve certainty or timing. Be sure to mention profit to cash conversion, working capital, capital expenditure, timing, tax, financing, restricted cash, liquidity, forecast uncertainty, and why cash visibility matters in an investment-heavy energy business. Question 20. How would you analyze working capital performance? I would analyze receivables, payables, inventory, accruals, and other operating balances using both balances and days-based metrics. I would compare movements with billing, collections, supplier terms, procurement activity, seasonality, and project milestones. A favorable cash movement might simply reflect delayed payments, so I would test sustainability and operational consequences. I would work with commercial, procurement, and operations teams to identify practical actions while protecting service quality, supplier relationships, and accurate cutoff. Focus on receivables, payables, inventory, accruals, billing, collection patterns, payment terms, seasonality, operational causes, cash impact, and distinguishing sustainable improvement from temporary timing benefits. Question 21. Tell me about a time you found an error in financial analysis. In a monthly analysis, I noticed a cost trend that conflicted with operational activity. I traced the issue to a duplicated data extract caused by overlapping reporting dates. I quantified the impact, informed the reviewer promptly, corrected the analysis, and checked whether other periods were affected. Afterwards, I added a duplicate record test and clarified the extraction procedure. The experience reinforced that curiosity, prompt escalation, and stronger controls are more valuable than quietly adjusting an incorrect number. Make sure to cover the detection method, impact assessment, immediate correction, transparent communication, root cause analysis, control improvement, and how you maintained trust without blaming colleagues. Question 22. Describe a time you challenged a stakeholder's forecast assumption. A stakeholder forecast a rapid volume increase based on an early commercial pipeline. I asked for supporting evidence, compared the assumption with historical conversion rates, and separated signed activity from prospects. Rather than reject the plan, I modeled a base case using evidenced volumes and an upside case reflecting the pipeline. We agreed to use the base case for forecast governance while tracking leading indicators. That preserved ambition but kept the published outlook credible and transparent. In your answer, discuss respectful challenge, evidence, alternative assumptions, sensitivity analysis, collaborative problem solving, documented agreement, and balancing commercial ambition with forecast credibility. Question 23. How do you prioritize when several deadlines coincide? I prioritize by deadline, materiality, business impact, and dependency. A regulatory or month-end deliverable with fixed timing would usually take precedence over a flexible analysis, but I would confirm priorities with my manager. I would break work into critical and optional elements, reuse validated data, communicate realistic timings, and escalate conflicts early. I would not compromise key controls for speed. Instead, I would narrow scope, obtain review efficiently, and deliver a clear, accurate output. Be sure to mention materiality, business impact, fixed reporting deadlines, dependencies, effort, stakeholder communication, quality controls, and escalating conflicts early rather than sacrificing accuracy silently. Question 24. Which Excel or analytical tools do you use for FP&A? I use Excel confidently for analysis, including SumIfs, XLOOKUP, pivot tables, data validation, charts, sensitivity tables, and reconciliation checks. I have also used Power Query to standardize recurring data preparation and reduce manual handling. Where available, I would use Power BI or another reporting tool for governed dashboards, while retaining clear source documentation. My priority is not using the most sophisticated tool. It is building a controlled, understandable process that produces timely and decision-useful analysis. Focus on practical Excel capability, pivots, lookups, SumIfs, Power Query, charts, scenario tools, data validation, SQL or by exposure, automation, and choosing tools that improve control rather than complexity. Question 25. What would you do in your first 90 days as a ScottishPower FP&A Analyst? In the first month, I would learn the business structure, planning calendar, reporting definitions, systems, key controls, and major value drivers. In the second, I would meet stakeholders, understand their priorities, review recurring reports, and test how actuals flow into forecasts. By the third, I would take ownership of core deliverables, improve one practical process, and provide useful variance insight. I would focus first on accuracy and reliability, then build confidence to challenge assumptions constructively. In your answer, cover learning the business and reporting calendar, understanding systems and controls, meeting stakeholders, reviewing KPIs and assumptions, delivering quick wins, and building credibility through accuracy and reliable communication. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.